imagine like waking up tomorrow and you look at your phone and your U.S. tech portfolio is it's down 30%.
Oh man, yeah. That's the nightmare scenario.
Right. And it's not because of, a bad earnings call in Silicon Valley or some domestic political crisis. It's because some central banker in Tokyo decided to raise interest rates by like 1%.
Yeah, literally 1%.
And you're just staring at your shrinking retirement account, trying to figure out how a tiny little adjustment in Japanese monetary policy just set fire to the entire American tech sector.
Yeah.
So today we're looking at the invisible tripwires of the global economy.
And it is terrifying when you realize how entangled these systems actually are, you know? Like, we tend to view our local economies or even our national stock markets in this vacuum.
Right.
We assume American tech stocks go up because, well, American tech companies are doing well. But under the surface, there's this massive, incredibly complex plumbing system of global liquidity. And right now, those pipes are absolutely groaning.
Yeah. So welcome to the Deep Dive, everyone. Today we are dissecting a really fascinating, incredibly high-stakes interview transcript.
It's a heavy one.
It really is. We're looking at a conversation featuring the economic commentator Peter Schiff, and he's speaking with Alex A. Janoff over on the Gold Republic Global Channel. And, the mission for today is to connect some very large, very scary dots for you.
Yeah, we're really getting into the weeds of how everything connects.
Exactly. We're going to unpack how a shifting monetary policy in Japan, a potential AI bubble here in the U.S., our skyrocketing government debt load, and this geopolitical race for physical gold, how all of those things are fundamentally the exact same story.
Right.
So, okay, let's unpack this. And I guess we should start with that tripwire over in Tokyo.
Yeah, Tokyo is definitely the perfect place to start. I mean, to understand the fragility of the entire global financial system right now, you have to understand Japan. Because Japan has basically been acting as the anchor for a massive amount of global liquidity for decades. Like, let's look at the specific numbers that Schiff lays out in the interview.
Okay, lay them on me.
So Japan's 10-year government bond recently hit a 30-year high in terms of yield.
Wow, 30 years.
Right. Now, in any normal economic environment, when government bond yields start spiking that aggressively, a central bank has to step in. They have to raise their baseline policy rates to cool things down.
To keep the currency stable.
Exactly.
Oh.
But the Bank of Japan, the BOJ, they're paralyzed. They are keeping their policy rate incredibly low, like sitting at just around 1%.
Which is crazy to think about. I mean, they're keeping it at 1%, while the Japanese government is running a budget deficit of, what, about 2% of their GDP?
Yeah, about 2%. So you have a government that's constantly borrowing money and a central bank that is completely refusing to raise interest rates to defend their own currency.
So what happened?
Well, the mathematical result is a complete collapse in the purchasing power of that currency. I mean, the Japanese yen recently hit a 40-year low against the U.S. dollar.
A 40-year low, which, that is an absolute disaster if you live in Japan.
Oh, yeah, completely.
Because we're talking about a highly developed, densely populated island nations, right?
Mm-hmm.
They have to import almost all of their food and almost all of their energy.
Right. They don't have those natural resources natively.
Exactly. So if the yen is crashing and they're buying oil priced in dollars or wheat priced in dollars, suddenly that becomes exorbitantly expensive.
You get massive internal inflation.
Yeah, and a completely blown up trade deficit.
And Schiff points out that the Bank of Japan has tried to play games to fix this without actually raising rates, like they've done foreign exchange interventions.
Right, which is basically what...
It basically means the central bank goes into the open market and just buys its own currency to create artificial demand.
Oh, to prop the price up.
Ugh, exactly. But that is a temporary Band-Aid on a gaping wound. Ultimately, the Bank of Japan will have no choice. To save the yen from hyperinflation, and literally prevent their citizens from starving in the dark, they are going to have to hike interest rates substantially.
And that inevitable interest rate hike is the tripwire we were talking about at the beginning.
Yep, that's the one.
Because that is the exact moment the global financial system essentially gets a margin call because of something called the yen carry trade.
Yes, the yen carry trade.
I really want to slow down and dig into the mechanics here because this is one of those financial concepts that sounds like, Wall Street jargon, but it's actually a very simple and very dangerous strategy.
It's arbitrage, but on a massive scale. So let's walk through the actual math of how a carry trade works.
Okay.
For decades, the Bank of Japan has kept interest rates at basically zero. In fact, for a long time, they were literally negative.
Which is wild.
Right. So if you are a massive institutional investor, like a hedge fund or a Japanese pension fund, you can borrow massive, almost limitless amounts of money in Japanese yen, and it costs you practically nothing in interest.
You're just getting free money.
Basically. But you don't just leave it sitting in yen because it doesn't earn anything there.
Right.
You take that borrowed yen, you immediately convert it into US dollars on the foreign exchange market, and you buy assets in the United States that offer a much higher yield.
Okay, so you might buy U.S. Treasury bonds that are paying, what, 4 or 5%?
Exactly. Or you buy high-growth US tech stocks that you expect to appreciate rapidly.
Mm-hmm.
You simply pocket the difference between the high return you're getting in the American market and the tiny, basically zero interest rate you owe back in Japan.
And as long as the yen stays cheap and Japanese interest rates stay low,
Yeah.
it's like an infinite money glitch.
It really is. It's perfectly safe as long as those two variables don't change.
So I was trying to picture how to explain this in the real world to someone. And it's essentially like borrowing your neighbor's really cheap lawnmower to run a highly lucrative landscaping business.
Okay, I like this.
Right. So you pay him $1 a day to rent the mower, and you're making hundreds of dollars a day cutting lawns.
That's a great profit margin.
Exactly. It's a brilliant business model.
Yeah.
But then suddenly your neighbor realizes his own living expenses are going through the roof, and he demands a massive spike in rental fees for that lawnmower right at the exact moment your landscaping business hits a dry spell.
Yep.
The math of your entire business just flips on you overnight.
And what makes it so terrifying in this scenario is that your neighbor is the Japanese financial system, and that lawnmower is worth over $1 trillion.
Good Lord.
Yeah. The Japanese government alone holds about $1 trillion in U.S. treasuries, and that doesn't even account for the Japanese life insurance companies, the pension funds, and all the private corporate investors who hold just absolute mountains of U.S. dollar-denominated assets.
Okay, but hold on. You're making a massive global sell-off sound, like completely inevitable.
True.
And I'm looking at this and thinking, okay, let's say the Bank of Japan does exactly what Schiff expects in the interview, right?
Right.
They raise rates to, say, 3%, and the yen starts to rapidly rise in value against the dollar.
Okay.
Why do these Japanese investors absolutely have to dump their U.S. stocks and bonds? Like, why not just hedge the currency risk using derivatives?
Yeah.
Or just accept a slightly lower profit margin on the spread and just wait it out?
Well, that assumes they are playing with their own cash rather than highly leveraged borrowed money.
Oh, right, the leverage.
Exactly. Let's break down the two variables that hit you simultaneously when this trade unwinds. First, your cost of borrowing the yen increases because the BOJ just hiked rates,
Right.
so your monthly payment on that debt goes up.
Right.
But the second variable is the killer.
Ah.
The yen is rising in value against the dollar.
Ah. Because you owe the debt in yen, but your assets are sitting in dollars. Yeah.
Right. You borrowed weak yen to buy strong dollars. Now imagine the yen gets stronger. When you eventually have to sell your U.S. assets, take those dollars and convert them back into yen to pay off your original loan.
You're getting fewer yen for every dollar.
Yes. The exchange rate is actively bleeding your capital. You are getting squeezed on the interest rate, and you are taking a massive hit on the currency conversion. If you try to wait it out, you are mathematically guaranteeing a total loss of your capital.
Wow. So there's literally no waiting. The moment that math flips, it's just a race for the exit.
It triggers a cascading margin call. The only logical, financially sound move is to unwind the trade entirely and immediately.
Right.
You have to liquidate the asset you bought with the borrowed yen. You sell the U.S. stocks. You sell the U.S. bonds. You take those dollars, convert them back into yen before the exchange rate drops even further, and you pay off your yen debt.
And then I guess if they have any capital left, what do they do with it?
To the extent those Japanese investors are going to reinvest whatever capital they have left, they will just buy newly higher-yielding Japanese government bonds, keeping their money safe and domestic.
Okay, so if you're listening to this and you're holding a standard retirement portfolio that's heavy in U.S. index funds, this Tokyo rate hike is a direct, immediate threat to your savings.
Absolutely.
Because what we're describing is a massive, violent withdrawal of liquidity from the U.S. financial system. All this Japanese capital that has been quietly propping up American asset prices for the last decade suddenly sprints for the exits at the exact same time.
Which forces us to ask the next logical question in this whole chain reaction.
Right.
If trillions of dollars in speculative borrowed money flees the U.S. markets, what exactly has it been buying? Like, what specific assets are currently inflated by this foreign liquidity?
And according to the interview, The biggest sponge for capital right now, the sector absorbing all this speculative money, is artificial intelligence.
Right.
Which brings us to the AI illusion and what Schiff characterizes as an everything bubble.
Yeah, the structural argument here is that the U.S. isn't just dealing with an isolated 1999-style tech bubble. We are in an everything bubble.
Everything.
It encompasses stocks, bonds, commercial real estate, cryptocurrency, and right at the white-hot center of it all, AI. And the focal point of the vulnerability in AI is something called capital expenditures, or CapEx.
So we're talking about the sheer mind-boggling amount of money companies are pouring into building out AI infrastructure right now.
It is staggering. I mean, companies are borrowing vast amounts of money to build hyperscale data centers and to buy the highly specialized microchips required for AI processing.
Right.
And the fundamental assumption built into the astronomical stock prices of these tech giants is that this massive upfront capital investment today will generate incredible high-margin recurring revenue down the line.
But Schiff points out a massive fatal flaw in that assumption regarding the hardware itself, right? Like, we aren't building bridges or railroads here. We're building server racks.
Exactly. Let's explore the difference between a capital expense and an operating expense. Historically, a capital expense is something you buy once, and it provides value for decades. Like, you build a steel mill, it costs $1 billion, but that mill produces steel for 50 years.
Right.
But what the market is categorizing as a one-time capital investment in AI might actually turn out to be a recurring operating expense.
Because the tech gets old so fast.
Exactly. The technology is evolving so rapidly, we're talking about Moore's Law on steroids, that the incredibly expensive chips companies are buying today on credit might become entirely obsolete in 2 or 3 years when vastly superior, more efficient versions hit the market.
Wow. So you don't just build the AI factory once.
Yeah.
You essentially have to demolish and rebuild the factory every 36 months just to keep up with your competitors.
Yep. And if these companies are forced into an endless, brutal cycle of repurchasing depreciating hardware just to stay relevant in the AI arms race, they will never be able to recover a decent return on that initial capital investment.
Because they're just spending constantly.
Yeah. The billions they are borrowing aren't building a permanent, defensible economic moat. They're just paying a temporary entry fee for a race that never actually ends.
And here's where it gets really dark. The interview brings up something called vendor financing.
Oh, yeah.
NVIDIA, which is obviously the undisputed darling of the AI chip world right now, was mentioned as actively announcing major financing programs, which means they are essentially loaning money to their own customers so that those customers have the cash to buy NVIDIA's chips.
Which is, vendor financing is one of the classic flashing red indicators of a late-stage economic cycle.
Why is that?
Because when the supplier has to finance the buyer to keep product moving out the door, you have to fundamentally question whether the supplier's earnings are actually real.
Okay, let's break this down to a neighborhood level so people can really get it. It's like me lending you 20 bucks just so you can buy a glass of lemonade from my lemonade stand.
Okay.
You hand me the 20 bucks back, I give you the lemonade, and then I run around boasting to the rest of the neighborhood about my record-breaking $20 revenue.
Exactly.
But I haven't actually created any new wealth in the system. All I've done is create a debt obligation that you now owe me. The money is just moving in a circle.
And the survival of that circular debt obligation relies entirely on your ability to eventually sell that lemonade to someone else for a profit so you can pay back my loan.
Right.
If the end consumer demand for your lemonade isn't there, you default on the 20 bucks. My recorded revenue vanishes into thin air, and my lemonade stand goes bankrupt because I was booking loans as income.
Wait, I have to play devil's advocate here, because we hear this pessimistic take all the time, right? People always compare this AI boom to the dot-com bubble of the late 90s.
Right, the 1999 comparison.
Yeah, but look at what actually happened. The internet was real. The hype surrounding the web was completely justified in the long run. It literally changed human civilization.
It did.
And companies like Amazon survived an 80% stock crash to become absolute global juggernauts. Why can't AI follow the exact same path? Even if there is a pullback, aren't these companies fundamentally building the future of human productivity?
Well, Schiff entirely agrees that the technology is real. The interview explicitly notes that AI is likely a much bigger game changer than the internet, with an even greater potential to revolutionize human living standards.
Okay, so then what's the problem?
The problem is that technological success does not guarantee financial success for the early investors.
Ah. because being right about the technology doesn't protect you from bad math.
Exactly. Look closely at the history of that dot-com bust. The vast majority of those early internet companies didn't just suffer a temporary stock pullback. They went to absolute zero. They were completely wiped out.
Right. Pets.com and all that.
Right. Amazon was a spectacular historical anomaly, not the baseline rule. And the conversation specifically points to a much more accurate parallel. Cisco in the late 1990s.
Okay, Cisco. They were the company building the actual plumbing of the internet, right? Like the routers and the switches?
Yes, they were the NVIDIA of the dot-com era.
Yeah.
Everyone needed their hardware to get online, and Cisco engaged heavily in vendor financing.
Oh, wow. Did they really?
They did. They loaned billions of dollars to emerging telecommunications startups so those startups could buy Cisco routers. And it made Cisco's revenue look astronomical.
Right, just like the lemonade stand.
Exactly. But when the dot-com bubble popped and those telecom startups couldn't generate enough consumer revenue to survive, they went bankrupt. They defaulted on the loans.
And Cisco took the hit.
Cisco's artificially inflated earnings collapsed. Their stock crashed over 80%, and it triggered a massive contagion event across the entire NASDAQ. It took Cisco over 2 decades just to recover to its previous peak.
That is wild. So if you are holding tech-heavy index funds right now, you really need to look under the hood of these earnings reports.
You really do.
You need to ask yourself, if the massive profits of the biggest tech companies in the world are driven by actual organic demand from everyday consumers paying for AI services, or if they are being fueled by this circular debt structure.
Because if that Japanese carry trade unwinds,
Right, back to Japan.
and the global cost of borrowing spikes, the cheap capital keeping that circular debt structure alive just evaporates.
So if the underlying startups default, it creates a cascade.
Exactly. The AI vendor loses the revenue stream, the debt on their balance sheet goes bad, the stock valuation resets violently to the downside, and the contagion spreads instantly through the broader equity markets.
Which brings us to the next even more massive problem in this chain. Because it's not just tech companies relying on massive unsustainable debt to keep the lights on, right?
No, it's not.
The biggest debtor of all the entities sitting at the very dead center of this financial Rube Goldberg machine is the United States government.
Yeah.
And according to the data discussed in the interview, the U.S. government is about to hit a terrifying, insurmountable mathematical wall.
The sheer scale of the sovereign debt issue we are facing is almost difficult to conceptualize. Like, the United States government is currently sitting on a nearly $40 trillion deficit.
40 trillion.
But the absolute size of the debt isn't even the most precarious part. The real danger lies in how that debt is structured.
Okay, how is it structured? Because, like, when I take out a loan for a house, I lock in a fixed 30-year mortgage so I know exactly what my payment will be for the next 3 decades. Isn't the government doing the same thing?
They are doing the exact opposite. The Treasury Department has not locked in long-term fixed rates for all of this debt. Instead, they have been relying heavily on short-term treasuries.
Okay.
They are rolling over massive amounts of debt on a continuous basis. The data highlighted in the interview shows that over the next 12 months alone, around $8 trillion of short-term government debt is maturing and needs to be rolled over.
Okay, let's explain rolled over, just so we are perfectly clear on the mechanics. This means the old debt matures, right? The government technically has to pay the bondholders back their principal. But because the government runs a deficit and doesn't actually have the cash to pay anyone back, they just issue a brand new bond, sell it, and use that new cash to pay off the old bond.
That's exactly it. It is the definition of a Ponzi structure. But it's entirely legal when a sovereign government does it.
Right.
However, here's the critical vulnerability in that rollover process. When you issue that new debt today to pay off the old debt, you have to pay today's prevailing interest rates.
And today's interest rates are significantly higher than they were just a few years ago when that initial debt was issued.
Exactly.
Okay, let's go back to our analogies. It's like living entirely on a credit card. But instead of taking out a nice, stable 30-year fixed mortgage on your house to consolidate your debt, you are essentially forced to refinance your entire house every 90 days at whatever the current market rate happens to be.
That's a great way to look at it.
If the bank's interest rate jumps even a tiny bit, your mandatory monthly payment skyrockets instantly. And because you have no fixed safety net, you are immediately bankrupt.
And we are already seeing the mathematical reality of this short-term refinancing crunch play out in real time.
Really?
Yeah. The text notes that the net interest expense for the U.S. government, and we're just talking about the interest here, not paying down a single penny of the principal.
Just the interest.
Just the interest. It hit an annualized $1.6 trillion in June.
1.6 trillion.
Let's provide some historical context for that number, because Schiff points out that $1.6 trillion was the size of the entire United States federal budget as recently as 1997.
Wow.
We are now spending an entire 1997 government budget, which covered the military, Social Security, infrastructure, education, everything, just to service the interest on our current debt.
That is mathematically unsustainable. It's a death spiral.
Yeah.
So what is the Federal Reserve doing about this? I mean, their entire mandate is to manage the system and keep it stable.
Well, the consensus in the interview is that the Federal Reserve is completely paralyzed. They are trapped between two impossible choices.
What are they?
From an economic standpoint, they need vastly higher interest rates to actually combat inflation and to offer a high enough yield to attract foreign buyers to purchase this massive $8 trillion flood of new debt.
Right.
But from a fiscal standpoint, the U.S. government physically cannot afford the interest payments if rates go up to where they organically need to be.
The interview mentions the Fed hiding behind bureaucracy to avoid dealing with this, right? Like they're just stalling.
Yes, Schiff suggests that the Fed is effectively hiding behind newly created task forces. Like, they form committees to study the problems, using these bureaucratic groups as an excuse to maintain a holding pattern.
So they don't have to do anything.
Right, it allows them to avoid making difficult, market-spooking interest rate hikes right before major elections. They're basically masking their paralysis as deliberate study.
I want to touch on something else that came up regarding government interventions, specifically the topic of tariffs.
Okay, yeah.
Because when a government feels trapped monetarily, they often start pulling trade levers.
Yeah.
Right. How does this fit into the picture of a paralyzed system?
So it's important we approach this strictly from the economic perspective presented in the interview, maintaining absolute neutrality regarding the domestic politics of it.
Of course.
Schiff argues that tariffs are often utilized as a mechanism of executive overreach when policymakers are trying to manipulate an economy they are losing control over. He notes that the Supreme Court recently struck down certain tariffs, deeming them unconstitutional.
Right, because the Constitution gives the power to levy taxes and tariffs to Congress, not the executive branch acting unilaterally.
Exactly. And he claims that new tariffs currently being proposed, which are often framed around moral or geopolitical issues like forced labor, are essentially unconstitutional workarounds.
Oh, I see.
They are manufacturing a secondary justification to impose taxes without having to secure congressional approval. So from the economic viewpoint expressed in the source, this is just another glaring example of panicked policymakers enacting market interventions that violate established rules simply because they are desperate to exert control over a spiraling fiscal situation.
But wait, if we go back to the Federal Reserve and interest rates, what if the incoming inflation data showed just a slight slowing?
Yeah.
Like, couldn't the Fed execute a small, symbolic 25 basis point rate cut or hike? Just a tiny adjustment to signal to the bond markets that they are still at the wheel and in control of the situation.
This raises a really fascinating question about the psychology versus the strict mathematics of central banking.
Okay.
The argument made in the interview is that a 25 basis point move is mathematically irrelevant when you are staring down a $40 trillion debt pile.
It's a drop in the bucket.
It does absolutely nothing to change the fundamental trajectory of the debt spiral. If rates are structurally too low by 300 or 400 basis points, moving the needle by 0.25% is pure, unadulterated theater.
It's basically bailing out the Titanic with a thimble while the orchestra plays.
That's exactly what it is. It is entirely psychological, a performance for the financial media. But the grim reality of keeping those rates artificially suppressed, which they have to do to save the government from a default, has severe compounding consequences for everyone else in the real economy.
Right.
Because when you artificially suppress interest rates below the real rate of inflation, you cause a massive misallocation of capital across the entire economy, and you relentlessly drive up the cost of living.
And this right here is the explanation for why your grocery bills, your car insurance, and your housing costs feel completely out of control, even when the government tells you the economy is doing great. It is a hidden tax. The government is artificially suppressing interest rates because it mathematically cannot afford its own debt, and everyday citizens pay the price through the silent devaluation of their purchasing power at the supermarket.
It is the inflation tax. It acts as a direct substitute for explicit taxation. because a politician doesn't want to pass a law raising your income tax by 20%.
Right. Obviously not. They'd get voted out.
So instead, they print the money, devalue the currency, and your groceries go up 20%. It achieves the exact same transfer of wealth from the citizen to the state, and this perfectly bridges the gap between high-level monetary policy in Washington and the physical, tangible economy we all live in.
So let's explore that physical reality. What does this all mean for the real-world goods we rely on every single day? Like, if the dollar is structurally weak because the government has to print trillions of dollars just to service its debt, what happens to the price of keeping the lights on and keeping the supply chains running?
Well, the interview makes a very firm, ominous prediction based on this data. The prediction is that the global economy, particularly Western developed nations like the U.S., is heading toward a sustained, brutal period of stagflation that will define the next several years.
Okay, let's define stagflation clearly, because unless you lived through the 1970s, you probably haven't experienced it. And it is generally considered the absolute worst-case scenario for a central bank.
It is an absolute nightmare scenario. Stagflation is stagnant economic growth, meaning rising unemployment, corporate earnings dropping, businesses closing, general recessionary conditions combined simultaneously with rampant aggressive inflation.
Which is usually contradictory, right? Because usually in a normal recession, demand falls, so prices drop.
Right, but in stagflation, the monetary system is so broken that you lose your job, you have less money to spend, and yet the price of bread and fuel still doubles.
And according to the interview, the primary catalyst that is going to ignite this next devastating wave of stagflation is energy, specifically the price of crude oil.
Yes, because oil is the master commodity. It dictates the baseline cost of producing, harvesting, and transporting almost everything else on the planet.
And the text acknowledges that geopolitical conflicts, like tensions in the Middle East with Iran, they certainly cause short-term uncertainty and temporary spikes in the oil market, right?
They do, yeah. But the core argument here is that the true unstoppable catalyst for structurally higher oil prices isn't geopolitical warfare. It's monetary warfare.
Interesting.
It is the inevitable breakdown of the U.S. dollar.
Okay, let's do the math on this because it's a complex mechanism.
Mm.
Why does the U.S. dollar breaking down mathematically guarantee that the price of oil skyrockets globally?
It comes down to a concept called the terms of trade and how global commodities are priced. On the international market, oil is priced and settled in U.S. dollars. Every nation on Earth needs oil to run their economy, and they generally have to acquire dollars first in order to buy that oil.
Okay, let me walk through an example. Let's say a barrel of oil costs $100. Right now, if €1 roughly equals $1, a European importer pays 100 euros for that barrel.
Exactly. Now, imagine the U.S. government prints trillions of dollars to pay its debt, and the dollar begins to lose significant value against other major fiat currencies. Suddenly, that €1 buys $2.
So for the European importer, because the dollar they use to buy the oil is now half as valuable, that $100 barrel of oil effectively only costs them 50 euros.
You've got it. Because oil is priced in dollars, if the dollar drops in value on the foreign exchange market, oil effectively becomes artificially cheaper for everyone else in the world who is holding a stronger currency.
And what happens when the most vital, energy-dense commodity on the planet suddenly goes on a massive discount for billions of people in Europe and Asia?
Global demand surges violently in response to the perceived discount. Every nation starts buying more oil because their currency stretches further.
But the actual oil hasn't changed.
Exactly. The physical, tangible supply of oil coming out of the ground hasn't changed at all. So this massive surge in global demand eventually crashes into a fixed supply, which then drives the absolute dollar price of oil massively higher to find a new equilibrium.
And this circles all the way back to the domino we talked about in Japan at the very beginning. This dynamic is doubly devastating for a country like Japan. They import virtually all of their energy.
Yep.
If their currency, the yen, is crashing at the exact same time the absolute dollar price of oil is skyrocketing, they're getting brutally crushed on both ends of the transaction. They need more yen to buy the dollars, and they need more dollars to buy the oil.
It is a devastating terms of trade shock that can literally bring an import-reliant nation to its knees. And this crisis isn't just isolated to oil either. Schiff notes that the global economy has experienced years of chronic, systemic underinvestment in the physical capacity to produce all sorts of raw materials. Like, The new copper mines haven't been built, the oil refineries haven't been upgraded, the agricultural supply chains have been neglected. We fundamentally lack the physical infrastructure to meet rising global demand.
Hold on, let me throw a wrench into this stagflation thesis. Didn't we just see oil prices pull back recently? And furthermore, we just spent 20 minutes talking about the massive boom in artificial intelligence.
Sure.
If AI actually delivers on its promises, like increasing efficiency across the board, optimizing global logistics, streamlining manufacturing processes, couldn't that massive technological leap in productivity offset the lack of supply in raw materials?
That is the utopian hope of the tech sector for sure, but the physical reality on the ground contradicts it entirely. AI does not exist in a digital vacuum. It requires immense physical, tangible infrastructure.
Right.
The interview points out that powering the massive hyperscale data centers required to train and run advanced AI models actually vastly increases the global demand for energy. AI isn't saving energy, it is devouring it. You cannot write a software algorithm to compute your way out of needing electricity.
So AI is actually pouring gasoline on the energy demand fire, not putting it out.
Exactly. And simmering beneath all of this physical supply and demand imbalance is the massive, unexploded ordnance of the global money supply.
Money printing.
Right. The interview emphasizes that the sheer, unprecedented volume of fiat currency printed by central banks globally since the COVID pandemic has built in latent inflationary forces that are only just beginning to rear their heads.
So you're saying the inflation we already saw wasn't even the worst of it?
The inflation we've experienced over the last few years was just the initial tremor. The argument here is that the actual earthquake is still coming as that newly printed money fully circulates through the real economy.
This means we really have to prepare for an economic era where the cost of physical, tangible goods, the food on your table, the electricity powering your home, the base commodities required to build everything, rises aggressively, simultaneously, alongside a stagnating recessionary job market.
Yeah.
We're facing the stagflation vice grip.
And in a stagflationary environment, the central defining question for anyone who has managed to build wealth or save money becomes, where do you hide?
Right.
With fiat currencies fundamentally broken and structurally designed by governments to lose value over time in order to inflate away their massive debts, where is capital seeking a true safe haven?
If dollars are bleeding value and stocks are exposed to the AI bubble and the yen-carry trade unwind, where do you put your money? Which transitions us perfectly to the modern gladiator match of the financial world. When fiat currency burns, what rises from the ashes? Let's talk about the battle of the safe havens, gold versus Bitcoin, and specifically a deep dive into the MicroStrategy corporate house of cards.
The interview provides a really fascinating, highly technical snapshot of the current state of traditional hard assets. In the scenario discussed, gold has decisively broken out, surging past the $4,000 an ounce mark.
Wow.
Yeah, and silver has broken through massive, multi-year overhead resistance levels, hitting around $57 an ounce.
Which is huge.
Yeah.
But what about the dips?
Mm.
Because people always point to the pullbacks.
Well, Schiff clarifies that the recent multi-billion-dollar wipeouts and price drops we've seen in these precious metals were simply normal, healthy market corrections that inevitably follow massive, unprecedented price gains. It shakes out the weak hands before the next leg up.
Right.
Furthermore, the argument is made that gold and silver mining stocks, the actual companies pulling this physical metal out of the earth, remain significantly historically undervalued relative to the rising price of the underlying asset they produce.
So gold and silver are basically doing exactly what they have done for 5,000 years of human history, which is preserving purchasing power in the face of sovereign currency debasement.
Yes.
But then we have the new challenger in the arena, Bitcoin, digital gold. And the interview spends a significant amount of time aggressively tearing down the biggest corporate champion of Bitcoin, a company called MicroStrategy.
Yeah, Schiff is deeply, fundamentally skeptical of Bitcoin. He views it entirely as a speculative distraction, a digital illusion that lures vital capital away from physical gold.
And to illustrate the inherent vulnerability of the Bitcoin ecosystem, the conversation focuses heavily on the highly leveraged corporate model of MicroStrategy, led by Michael Saylor.
Let's break down the MicroStrategy playbook step by step, because when you look at the mechanics, it is wild.
It really is. So according to the data discussed, MicroStrategy has spent over $60 billion buying Bitcoin. They are one of the largest holders in the world. But it's how they bought it that is the structural issue, right?
Yes. They didn't just use existing free cash flow from their software business to buy this Bitcoin. They aggressively utilized the public capital markets. They issued massive amounts of debt, specifically convertible bonds and preferred shares, to raise billions in fiat currency from traditional
Which
investors.
they then immediately turned around and used to hoard Bitcoin.
Exactly. And this constant, massive, leveraged buying pressure from one single corporate entity acted as a primary engine driving the price of Bitcoin up over the last few years.
But the music has stopped. The interview points out that MicroStrategy has largely stopped their aggressive Bitcoin purchasing. And worse, they now have to pay the piper on all that debt they issued.
Yes, they do.
They are legally obligated to pay large recurring dividends on those preferred shares they sold to get the money in the first place.
And this is where the financial engineering completely unravels. To pay those massive dividends to the preferred shareholders, they're not selling any of their precious Bitcoin. They refuse to part with the asset.
So where are they getting the cash?
Instead of selling Bitcoin, they are actively selling newly issued common stock into the open market to raise the cash required to pay the yield on the preferred stock.
Okay, let's use an analogy to clarify how insane this is. This sounds exactly like a guy who goes to the bank and takes out a massive second mortgage on his house just to buy a mountain of scratch-off lottery tickets.
Okay.
Then, when the hefty monthly mortgage payment comes due, he refuses to cash in or sell a single one of the lottery tickets. Instead, he starts selling off the furniture in his living room, his television, his car, just to pay the interest on the loan so he can sit in an empty house and stare at his pile of tickets.
That is exactly what it's like. It is a self-perpetuating, destructive spiral of shareholder dilution. By issuing new common stock to pay the debt, they are increasing the total number of shares, which means every existing share is worth a little bit less. The interview points out the direct consequence of this. The Bitcoin yield for MicroStrategy investors, which is a specific metric the company uses to try and measure value creation per share, plummeted dramatically, dropping from 13.3% down to just 4.5% in a very short period.
Wow, that's a huge drop.
Yeah, the core argument here is that by selling common stock to fund the preferred dividends, the company is deliberately, systematically destroying common shareholder value to protect their leveraged crypto position.
Well, let's look at the counter-argument for a second. Couldn't you argue that MicroStrategy is actually providing a valuable market service? Like that they act as a publicly traded, regulated, speculative layer? Maybe retail investors and institutional funds are perfectly willing to pay a premium to a publicly traded company to handle the complex custody, the cold storage security, and the auditing of the Bitcoin for them, rather than dealing with unregulated crypto exchanges or hardware wallets themselves.
I mean, if that thesis were true, the free market would reward the stock with a premium valuation. But Schiff refutes this premise entirely using hard market data. MicroStrategy is not trading at a premium to the Bitcoin it holds. It is actually trading at a massive, glaring discount to its net asset value, or NAV.
Let's define that. A discount to NAV means the entire market capitalization of the MicroStrategy stock is currently worth less than the market value of the actual Bitcoin sitting in their digital wallets.
Exactly. The interview states this discount has reached up to 40% of the Bitcoin value per share. The broader market is actively, aggressively punishing the company's financial model. The market is saying, we don't trust your leverage. They are not creating value, they are destroying it.
And the prediction laid out in the text is what?
A total catastrophic unraveling of this model. The common stock price goes down, which forces margin calls, which forces Bitcoin down, which causes the preferred shares to lose value, leading to the whole highly leveraged house of cards collapsing in on itself.
And the contrast drawn in the interview between this and physical precious metals is incredibly stark, right? Because while a digital asset heavily reliant on corporate financial engineering and immense leverage is vulnerable to a death spiral, gold and silver operate on fundamentally different physics.
Yes. Schiff puts it very elegantly. He says gold and silver do not have a price ceiling because fiat currencies like the US dollar do not have a price floor.
The US dollar can go to zero.
Exactly. Because it is backed by nothing but the full faith and credit of a government currently $40 trillion in debt, it can mathematically fall to absolute zero. It has happened to fiat currencies countless times in history, from Weimar Germany to modern-day Argentina.
Wow.
In a scenario where the currency collapses to zero, The price of gold measured in that currency becomes infinite. Gold doesn't change, it is just being priced in a worthless metric.
So if you are actively seeking to protect your savings from the stagflation we talked about earlier, this analysis really challenges you to look hard at your portfolio. You need to deeply critically evaluate your chosen safe haven. Like, are you holding an asset with thousands of years of intrinsic physical value that has survived the collapse of every major empire in history? Or are you holding a digital asset currently being propped up by a few heavily leveraged corporations selling the office furniture to pay the rent?
It's a critical distinction for individual investors managing their own wealth, but the implications of this flight to safety expand far, far beyond individual retirement portfolios.
Also,
Well, if everyday citizens are looking at physical gold as the ultimate safe haven to survive a currency collapse, what happens when entire sovereign superpowers realize the exact same thing?
oh wow. Which brings us to the final and frankly the most massive geopolitical element of this deep dive. We are talking about the endgame. De-dollarization and China's strategic move to corner the gold market. Because if the dollar collapses under its own debt weight, nature abhors a vacuum. Someone is waiting to step in and dictate the new terms of global trade.
The interview outlines what is arguably the ultimate looming crisis for the West. The United States dollar losing its undisputed century-long status as the world's primary reserve currency.
This is the big one.
This is the economic event horizon. If the dollar loses that protected status, the U.S. faces a catastrophic combined sovereign debt and currency crisis that would make the 1930s look tame.
Let's explain why reserve status is so vital. Right now, the only mathematical reason the U.S. can sustain a $40 trillion debt and print trillions of dollars without immediately causing hyperinflation is because the rest of the world has to buy and hold our dollars to conduct international trade. We basically export our inflation. If they don't have to hold dollars anymore, all those trillions come flooding back to our shores and the whole system collapses. And according to the interview, China is actively, quietly building the exit door for the rest of the world.
The sheer scale of China's macroeconomic preparation is staggering. The conversation delves into widespread, credible speculation that the Chinese government and its proxy central bank have been secretly hoarding massive amounts of physical gold for years.
Wait, secretly hoarding?
Yeah, while official, publicly reported numbers are kept artificially lower, some prominent commentators and analysts suggest China's true, off-books gold holdings could be upwards of 30,000 tons.
30,000 tons of physical gold. That is an almost unimaginable amount of concentrated physical wealth. It would completely dwarf the stated reserves of the United States.
But the critical point is that they aren't just hoarding it in a deep cave to look at it, they are weaponizing it financially. China is systematically building the global infrastructure required for a gold-backed alternative to the dollar.
Okay, what kind of infrastructure?
They're establishing massive, high-security gold vaults in Shanghai. They are negotiating entirely new trade paradigms with major commodity producers. For instance, they're in deep discussions with Saudi Arabia regarding the prospect of paying for massive shipments of Saudi crude oil using a newly created gold-backed Chinese yuan, completely bypassing the U.S. dollar.
So if we zoom out and connect this to the bigger picture of economic history, what does this actually mean for the balance of global power? How does a currency become the reserve standard in the first place?
If we connect this to the bigger picture, it means the fundamental foundation of economic hegemony is shifting right under our feet. Historically, obtaining and keeping reserve currency status requires immense underlying economic productivity. A currency must be backed by something tangible that the rest of the world needs. For a long time, the U.S. dollar was physically backed by gold.
Yeah.
When we unilaterally abandoned the gold standard in 1971, the dollar survived because it was still backed by vast, unparalleled American industrial production and the petrodollar agreement with the Saudis. The world needed dollars because the U.S. manufactured everything, and you needed dollars to buy oil.
But Schiff argues we don't have either of those fundamental pillars anymore. We outsourced our manufacturing base, and we are heavily in debt.
Correct. The U.S. dollar is now backed by neither physical gold nor dominant industrial manufacturing. It is backed purely by historical inertia, perceived confidence, and the reach of the U.S. military.
And China.
Meanwhile, look at China. They have become the undisputed largest manufacturer in the world. They're soon to be the world's largest creditor nation, meaning they lend money to everyone else. They possess the massive national savings rate and the physical industrial production capacity that the U.S. used to have back in the 1950s. By linking their currency, the yuan, to a massive auditable stockpile of physical gold, they are preparing a viable, mathematically sound, hard asset alternative to the rapidly depreciating fiat US dollar.
Okay, let me play the skeptic here again, because this narrative of the dollar's demise has been floating around for decades, right?
Sure has.
The U.S. dollar has been the undefeated king of global finance for a century. The entire planet runs on dollar rails. The SWIFT banking system, global shipping insurance, international debt markets, it's all dollars. Even if China really is secretly hoarding 30,000 tons of gold, and even if they build a few high-tech vaults in Shanghai, does that really mean they can just rewrite the deeply entrenched rails of international trade overnight? It just seems too complex, too sticky to untangle.
Well, Schiff wouldn't argue that this historical transition happens overnight on a Tuesday. A macroeconomic shift of this magnitude is a grueling process, not a single cinematic event. But building the physical plumbing and the alternative financial infrastructure, the Shanghai vaults, the cross-border interbank payment systems, the bilateral swap lines, that is the mandatory first step. You cannot replace the dollar until a fully functional, trustworthy alternative exists and has been stress-tested.
So they are basically laying the plumbing beneath the house while we're distracted arguing in the living room.
Precisely. And once a critical mass of essential life-sustaining global commodities, most notably Saudi oil and Russian natural gas, can be demonstrably and reliably settled and converted into gold via the yuan, the game theory changes entirely.
How so?
Countries in the global south that are exhausted by U.S. fiscal instability, countries that are tired of importing American inflation and being subjected to dollar weaponization via sanctions, they will suddenly have a mathematical hard asset alternative. They won't have to hold depreciating U.S. Treasury bonds in their central banks anymore.
And once the rest of the world doesn't have to hold our debt to survive, the $40 trillion domestic house of cards we talked about earlier finally definitively collapses because there are no buyers left for the debt.
The interview is unequivocal on the trajectory of this historical transition. America dominated the 20th century, economically, militarily, and monetarily. But based on the severe erosion of domestic industrial capacity, the weaponization of the currency, and the explosion of unpayable compounding sovereign debt, the argument presented firmly believes the U.S. will not economically dominate the 21st century. The torch is being passed back to tangible assets.
Wow. Okay. Let's pull all of these massive threads together because we have covered an incredible amount of ground today.
We really have.
We started by looking at a single, seemingly isolated lever in Tokyo, the Bank of Japan, being mathematically forced to hike interest rates to save their crashing currency. We walked through the math of how that single action forces a brutal margin call on the yen carry trade, violently sucking trillions of dollars of speculative liquidity out of the U.S. financial markets.
Which then immediately exposes the extreme fragility of the everything bubble, specifically popping the massive debt-fueled capital expenditures in the AI tech sector that currently rely on circular vendor financing and cheap borrowing to survive.
Right. And as those asset prices correct downward and interest rates globally are forced to rise, we hit the impenetrable wall of the $40 trillion U.S. sovereign debt, where the government is trapped paying $1.6 trillion just in interest, relying on a completely paralyzed Federal Reserve that has no moves left on the chessboard.
That institutional paralysis and the subsequent inevitable devaluation of the fiat dollar ignite a devastating terms of trade shock, driving up the absolute cost of vital global commodities like oil and plunging Western developed economies into a prolonged era of structural stagflation.
Which sends global capital fleeing for a true safe haven. It exposes the corporate financial engineering and leverage of Bitcoin vehicles like MicroStrategy, driving sovereign wealth back toward the oldest, most reliable money on Earth, physical gold.
Ultimately accelerating the geopolitical endgame, where highly productive manufacturing nations like China utilize massive, hidden, physical gold reserves to build alternative financial plumbing, offering the world an exit door, dethroning the dollar, and ending a century of American economic hegemony.
It really is one giant, terrifyingly interconnected system. The dominoes are all lined up. But before we sign off, I want to leave you with one final provocative thought to mull over. Something that wasn't explicitly laid out in the interview, but builds perfectly on the foundation of everything we've just discussed regarding technology and money.
Let's hear it.
We constantly, arrogantly assume that the future of finance naturally belongs to the highest, most complex technology. We think it belongs to advanced AI algorithms processing milliseconds of trading data and sophisticated digital ledgers floating in the cloud. But what if the ultimate financial innovation of the 21st century turns out to be a regression? What if, after all our complex financial engineering, all the vendor financing, the synthetic derivatives, and the currency swaps, global survival requires abandoning the digital illusion entirely and returning to the oldest, heaviest, most stubbornly physical asset on Earth?
It is a profound, humbling paradox to consider.
Keep questioning the consensus. Keep digging into the grim math hidden behind the optimistic headlines, and above all, stay curious. Because the plumbing of the global economy is shifting, and you need to know where the pressure is building. Thanks for joining us on this deep dive.